Good evening, students. I hope you are all doing good and, as always, engraved in your busy schedule, doing some hard work, a lot of practice. I'm back again, Chartered Accountant Manubhav Verma. At your service, we'll be continuing the discussion from the session on Thursday on working capital management. I'm sure most of you would have got an opportunity to try the question which I gave you as an assignment. That was based on the working capital management, wherein you had to ignore WIP for some relief. But at the end, I also gave you some tips of this particular question. So I hope you guys got your hands on this one. And probably after today's session, I will be uploading the questions with the solutions as well, so that you guys can look at the relative aspects of various questions which you want to practice at your discretion. Okay, so today, just before we continue, guys, I want to give a brief recap of what we discussed on Thursday is what is working capital, why working capital is important, various policies organization could have with respect to the working capital, and also the fact that how we calculate the operating cycle, including the raw material holding period, the finished conversion to finished goods period, holding of the finished goods, receivables, number of receivables days, and also adjusting the period enjoyed by the credit period given by the vendors. So we discussed some examples on the operating cycle calculation. Then we moved on to the working capital management. We tried a good question on the same. We understood the requirements of how to calculate different components with respect to inventory, including raw material, finished goods, and WIP, account receivables, and other aspects as well. Few important things which we discussed were with respect to the involvement of cost, and in fact, most of the times cash cost when we talk about receivables, because our working capital is what is blocked in the receivables is in the form of the cost. This is what we discussed while we calculated the working capital. Not only that, we also understood the requirement of the margin of safety. So today, guys, we would like to start the treasury management aspect. And now this is also very important. I'm sure most of you would remember that we had discussed a balance between the working capital, where I talked about the every organization has to include in the a good balance or strike basis on their requirements with respect to liquidity and profitability. When we talk about treasury management, we are talking about various aspects. It's not about maintaining liquidity. It's rather maintaining liquidity when it is required. When we talk about the treasury management, there are a lot of objectives this department has. Most of the big organizations have a separate department with respect to the same. Okay. I can see there is a question coming in the query panel from the last, I think, illustration of submarine enterprises from Karthik. That Karthik is asking that, isn't it possible that instead of more efficient, it result in high cost production, as generally wage rates increase in double shift for creating. Okay. I think what you are talking about, Karthik, is incorporating some practical challenges that may arise, right? But in the absence of information, we cannot assume so much. We were rather talking about production efficiencies rather than the challenges created by the labor or the labor union. I actually completely agree with your point. It's just that I appreciate that you understand that, okay, practical challenges could be much more. But as far as our examination is concerned, let's confine ourselves to the information given in the question. I absolutely echo with your point. Okay, so coming back, guys. So I was talking about that there are most of the corporates having this department as a separate department, treasury department. Now, I cannot forget a practical experience I was having when I was working in Whirlpool Corporation almost a decade ago. In fact, 9 years ago to be exact. And the treasury team used to sit just next to me. I remember that the guy was negotiating with our bank at that point of time for a fixed deposit rate for a fixed deposit for 5 days. And that discussion went on almost for 15 minutes. After the call got over, I talked to him. Really? You're talking about negotiation for 5 days fixed deposit? And I said that what is the deposit rate? Those were the days the rate was somewhere around between 4%, 3.5 to 4.5%, because it was too short term. But then he made me realize that, okay, since the amount the company has is not to be used anywhere for the next 5 days, and even if you deposit that for 4.5% somewhere, we might be able to pay salary for at least 3 admin people. Guys, do you realize that? Of course, companies at multinational level, we are talking about, receiving and payments in crores, right? So even if I am depositing that at a negotiated rate of interest, even for 5 days, and they give someone a 60,000 or a 1 lakh of interest, you never know. So the idea is here in terms of the treasury management that not only we plan to maximize the return on available cash, the example I was giving you, their role is also to act as a licensing point to negotiate whenever the firm is in the need of financial assistance. But be it overdraft, be it a long-term financial loan, they also negotiate the best of the rate. I'm sure everyone understands it's a jaw approach, right? When you say jaw, upper jaw reflects the returns and the lower jaw reflects the cost. Everyone wants to minimize the cost. Everyone wants to maximize the returns, right? And of course, we're talking about efficient mobilization of cash in ventures, like we discussed in investment decisions also. Now, why we are talking about the role of Treasury Department also? Because they coordinate with all the departments. They coordinate with various departments, account receivables, account payables, even the CapEx, internal projects team. They understand their requirements. They map the liquidity. They ensure that, okay, when is the cash coming in? When is the cash going out? When is the payroll going out? So the idea is that these are the guys who will be involved in mobilization of cash in various ventures and projects. But most importantly, I would definitely talk about that as a very important goal in the present day world. We are talking about hedging. I guess everyone agrees here that when we talk about the operations at international level, almost every organization would be dealing in international trade. Many organizations have their subsidiaries cross-border. And that results in quite a bit of operations and interactions in terms of the foreign currency. Not only that, these days, when we talk about avenues available to hedge any kind of a fluctuation in the prices of the products the company deals in. For example, let's take an example that a company is dealing into copper wire. Now, if we are talking about dealing into copper wire, a company has an inventory, but you are not receiving an order for at least for next 3 months. You may be worried about what if the copper wire price goes down. Guys, are you getting with me on this one? A company is dealing into copper wire and a company is actually having some kind of an inventory, but they're sure that they're not getting the order for the next 3 months. They might be worrying that, okay, the price of copper wire may go down. But guys, can you tell me, first question for the day, can you tell me why copper wire price may go down? Let me see the responses on the query panel. Hitesh says hedging is used to minimize the risk at certain levels. Absolutely correct, Hitesh. So what are we talking about here? I was asking about why a company dealing in copper wire is worrying that, okay, the copper wire price is going down. But my question was, why a copper wire price may go down? Okay, Siddharth says lack of demand. Sivan says lack of demand. Good answer. But think more closely, right? What would there be something else, the price of which will fluctuate and result in copper wire price? I think all the answers I'm getting right now, including Siddhanshu, Shakti, everyone is telling me lack of demand. But I want to go a step back. What would have went wrong with some other product, some other commodity that would have resulted copper wire price going down, right? Okay, someone said, Siddharth says due to trading in commodities. Guys, one of the, okay, I accept your reason, lack of demand. Okay, but guys, do you agree that, let's say the market is stable, but let's say that there is a fluctuation in the copper price. Do you agree, guys? And then when a company wants to hedge their interest, protect themselves in this situation, they really cannot look for any hedging for copper wire. There is no hedging available for individual products, right? The hedging, or when we talk about hedging, we talk about the, protecting the company, entering into a forward or a future contract to protect the company's interest. They probably can enter into a forward contract for copper in that case. So basically, guys, this is very important for us to understand that, yes, with a lot of globalization, a lot of international spread of operations over the last decade, this has become a very important goal of treasury management. It has been on the top list of their KPIs, that is key performance indicators for the treasury team. Now, coming from these goals only, they are talking about their functions, right? So I think every department will fix their goals and they will, they will kind of align their tasks accordingly. We're talking about cash management. As I said, in terms of cash management, let's say this is a treasurer, they will be having a lot of interaction with different departments, account receivables, accounts payables, your payroll. They're talking about your admin for their expenses. They also interact with taxes. It's a 360 degree. They're surrounded by a lot of functions, and look at that. How can they manage? They need to align that the company doesn't fall into a liquidity crunch. And that is why that 5-day fixed deposit negotiation was very important, right? So cash management, very important tool. Banking, guys. Now, every organization has a key person who has been interacting, listening with bankers, managers for quite a lot of time. And as you grow the relationship, as you expand the relationship, the longer it is, better it is for the organization. This is absolutely a kind of a broader term. Of course, this entails our discussion on the capital structure when we talk about the cost of capital, and not only that, but also the investment of it. So whatever requirements are in different projects, that covers under fund management. Now, currency management, I already explained to you. However, there is one interesting point is when we talk about the Forex, I think although you can enter into forward contracts for foreign currency, you can protect yourselves in terms of hedging, but what can be better than aligning your receipts and payments in the same currency falling on the similar dates? Are you getting me? If I have receipts and payments in euros, if I could align them probably either on the same dates or almost on the nearby dates, then I am kind of protecting myself automatically from a lot of Forex fluctuation. But as Siddharth said, that it's basically, we are talking about in terms of hedging is what he needs a more clarity. Siddharth, I saw your query that Siddharth, hedging means that you are basically entering into let's say a financial instrument to protect yourself. Hedging means to cover some kind of a risk, right? So if there is a Forex fluctuation, you will hedge your risk by entering into a forward contract. I think you can also check probably network at your end, because while I can see my screen and my audio seems to be okay at my end. Guys, I hope everyone can hear me out. Okay. So guys, everyone with me till this point? Okay. One more function the treasury team has expanded on over the last decade that is of a very strategic significance. That's a corporate finance role as well. Although in some of the big corporations, we are talking about a separate team who might be working on merger opportunities, looking for the acquisition opportunities of other companies, investor relations. But in some other companies, it is still as part of the treasury department. Let me just, okay, so guys, just can you please confirm if you guys can hear me out? I can see from a couple of students that they are having some audio issues. Can you please confirm? I hope people can hear me out now. Okay. So moving ahead, I hope everyone understands the goals and the functions of the Treasury Department. Now, as we talk about the first function itself, the cash management, I would like to talk about this a bit. In terms of the cash management, guys, very importantly, we need to understand that every organization, okay, I can see that many students are having some audio issues here. Can we, okay, can I request IT team to just please check if all okay? Because okay, but I think I can see that it is all connected well from my end. Is it okay now? Okay. Right now it's okay because I can see on the net on the YouTube it's working fine. Not sure about the portal though. Okay. Guys, I hope it is better now. Anyways, so let's continue. We talk about the cash management. So why an organization needs cash? There could be different needs. I think the basic answer is day-to-day operations. We talk about the transactional need here. So transactional need in terms of day-to-day expenses. That's very much basic. That's what I said. When the treasury team is surrounded by 360-degree view, we talk about the speculative need. And when we talk about the speculative need is, we talked about when the profitability and liquidity trade-off was being discussed, taking advantage of temporary profitable opportunities there. And I think we also discussed this margin of safety in working capital itself, where we are talking about the precautionary need, that you want to keep some liquidity for the rainy days, right? So in terms of cash planning and budgeting, I think very important to understand that every organization plans this in advance by coordinating with departments. Like for example, let's talk about how this team will be coordinating with the account receivables and the collections team. And let's say collection team says that, okay, most of the customers pay their dues in 50% in the next, next 30 days and rest of the 50% in the further 30 days. So you need to know that, okay, in terms of your revenue, the collections will be coming in 2 months. Similarly, you will probably liaison with your accounts payable team, to understand, okay, what is the credit period given by them. So what we are trying to say is that while we are liaising with all the teams, we need to understand when exactly is my inflow coming, when exactly is my outflow going. And those timings, coordinations can be split into not on an annual basis, but rather monthly basis. So I could rather make a monthly cash budget. The idea is to ensure that we do not either enter into any shortage or a liquidity crunch. Or on the other hand, we do not want to unnecessarily carry too much of excess to lose any kind of a opportunity cost. So now, as it comes to methods of cash budgeting, there are three different methods. Although we will be focusing on just one, but just for your knowledge, we're talking about receipts and payments method. We're talking about periodic information flow from various other budgets, like I told you about from a sales, from the purchase, from the capex. That's basically coming in from the other functional budgets. Then we talk about adjusted income method, wherein what we talk about is where we talk about the adjustment of delays in the payment and collection of and the non-cash items. Basically, it's very much similar to what do we do in the cash flow from operating activities and indirect method for cash flow statement, where we start from net income, we adjust the non-cash items, we adjust the working capital changes, and we kind of get to know the cash flow from operating activities. However, this method may not, I would say, fit in the perfect alignment in terms of the synergies between receipts and payments. Similarly, adjusted balance sheet, where we kind of calculate a common parameter, let's say a percentage of sales, and we kind of calculate the requirements of various assets, long-term, short-term liabilities, and we kind of calculate that as a percentage of sales, and we compare it with our long-term liabilities. That's, I think, the more common approach when it comes to the cash budget. Cash budget is what we will be talking about, a receipts and payments method, where we will be having the information from various departments. It's a kind of a 360-degree view where you get the information, okay, in which month what collection is coming. So we will be focusing our discussion on the first one, receipts and payments method, majorly. Okay, so again, the idea here is that what we need to know is that whether the company is ready for any kind of a contingency. On the other hand, do we have enough information to ensure that, okay, probably we can invest any surplus in the marketable securities, and also at the same time not carrying that much risk, right? So the idea is why we need a cash budget. Of course, I have been explaining this part where we are talking about coordinating the timings of cash needs, guys. Do you all agree that different departments may need liquidity at different times? Can anyone give me an example of a particular cash outflow which an organization may need on a quarterly basis and does not come every month? Can anyone give me an example? Can anyone give me an example of that? Siddharth says interest from bank. Very good. Siddharth, but interest from bank would be more of an inflow, right? I was asking about outflow. Any outflow can you suggest any outflow that may be done on a quarterly basis? Interest is a good example, probably from an inflow perspective. Okay, Sudhanshu says insurance charge. Sudhanshu, I have to accept your answer because insurance actually depends on the agreement, whether we want to pay it quarterly, monthly, or yearly. But that's okay. But yeah, most of the industry go it for yearly, right? At least from a business standpoint, we generally have yearly payments. Anyone else? Look at that. Now everyone is jumping up into GST. Wow. So guys, can we say taxes, whether GST, advanced tax, right? So I think now everyone is like moving on to the tax side. So I think now you understand probably, okay, we can think of another example of apart from insurance, what could be another yearly example? Let's say a bonus payment of the employees. So the idea is what I'm trying to say, guys, that why the coordination of the cash payments and receipts is very important, right? You do not want to be falling on the either side, as in like you don't have cash when you need it, or you have too much of cash. So that is why the cash budget, which actually will pinpoint those periods when there could be excess cash, and that would definitely, probably help the organization to take some advantage, let's say paying the vendors on time if they're offering any cash discounts. We will talk about this when we will be reaching the accounts payable management. If you have excess cash, either you invest it somewhere or take an arbitrage benefit of some other schemes, let's say provided by the vendors. Vendors at times provide you a cash discount on early payments, right? And also let's say if the company is planning for an expansion, that can also form part of your internal source of funds. That's what we discussed in the cost of capital as well, right? And not only that, what happens is that if you have everything in place coordinated, there could be a scenario where company might need some funds, but since you have your working in place, you may be more confident while negotiation, while liaising with the bank, and get that financing in your favor, or rather the terms could be negotiated the way you want, not entirely, but yeah, whatever the negotiation is, if you have your plan set out quite nicely. So, what are the steps here? Now, again, first of all, we need to identify the selection of period, right? So, overall, generally, as I said, we generally prepare the cash budget, which could be split on a monthly basis. Okay, Hitesh says cash outflow can be recurring deposit quarterly. Okay, Hitesh, again, the answer is good. The only thing is it depends on the arrangement, right? It could be monthly, it could be quarterly as well. Okay, so yeah, we are talking about the factors that could affect our cash flows. Specifically, we're talking about operating and financials. Now, here you can see that when we are talking about from a cash balance perspective, let's say we talk about a range where the company wants to be in, right? The company wants to generally ideally be in that range where they do not want to have extra surplus, and they neither wants to have a deficit. But still, what happens that if you do not have cash, don't you think the arrangement should be done in advance with the banks for any kind of a bank overdraft as it may need it? I'm sure you guys agree with me that bank overdraft is more of a limit you would be using as and when required. But since it entails a cost along with, you would not like to be always on the overdraft side. Also, it is just acting as a cushion for the organization. Right, guys? So we talk about in terms of the short period cash budget. And that is where I said that, okay, we'll be more focusing on the receipts and payment side. When we talk about cash budget from a longer period, then we could use the financial statement style of it, right? Either the balance sheet or the income statement. So, in terms of the requirements of the information, what estimates, what are inputs do we need? As far as the receipts are concerned, we need to know the receipt from debtors, or in other words, we are talking about the collection pattern. How many customers are paying when? Cash sales. And as you guys were talking about interest, dividend, any other source, right? With respect to the payments, again, we are talking about the payment pattern. So probably the vendor credit arrangements. Then we are talking about payments for expenses. I think you guys gave me a lot of examples. Let's say a company goes for a marketing campaign 3 times in a year. So again, the information in the question will tell you, which particular month have some specific expenses. Look at this, payments that are made periodically, but not every month. They're talking about debenture interest. I think you all gave an example of GST that was amazing. And then I also talked about the advance tax and so on. Also, ad hoc payments. Let's say the company decides to redeem some debentures or they repay some loans. And it could be also dividend payments that could also be there as part of the payments estimates. So let us take an example here, guys. I want everyone to roll up your sleeves. Everyone, eyes on the screen right now. I want everyone to be extra careful. A lot of information here, but I'm sure you guys will be with me while we solve this out together. Everyone ready, guys? We are now preparing a cash budget for 6 months for this company. We have given some information here with respect to the monthly numbers. Majorly, we need to be careful in what month we are talking about. And the cash budget we are preparing from is April 2019. So they have given us estimated sales from January to October. Okay, so they're talking about like 10 month sales. Then we are talking about in terms of the wages as well, January to September. Now, of the sales, 80% is on credit. I think that was enough for us. We could have assumed that, okay, 20% is for cash. But I think what also is being said indirectly that there is no bad debts probably. That's fine. So it's 80% of credit. Now, please be careful. 75% of the credit sales are collected within 1 month. So April sales is 80% is credit. 75% of that 80% will be collected in May. And 25% of that 80% will be collected in the second month after the sale. Can I say it is 60-20, guys? 75% of 80% is 60% of the sales. 25% of the 80% is 20% of the sales. So if I want to understand the collection pattern, sale month, 20% because cash sales are 20%. M plus 1, that is next month, 60%. M plus 2, 20%. Guys, I hope you got it. Everyone got it? Why I mentioned 60 and 20%? Because 80%, we multiply by 75%, we get 60. We multiply by 25%, that is the 20%. So it's a good way to look at it, right? Probably a calculation could be pretty easy now. No bad debt losses. Thank you for telling us. We could guess that 80 plus 20 is 100. Purchases amount to 80% of the sales. Now that's where you need to be careful, guys. Now gradually the information will be increasing and increasing for us. Purchases amount to 80% of the sales are made on credit and unpaid for the month preceding the sales. Wow. Yes, but don't you think that is very logical that in terms of obviously the purchases, the inventory has to be before the sales, right? That's fine. So in terms of the numbers, we need to be very careful now. Karthik says 20 or 40. Karthik, 20% for cash sales, right? Okay, Karthik has 2 points. Is it 20 or 40? And Karthik says, how could I say that there are no bad debts? Karthik, we're talking about 80% on credit and 20% on cash. And they had talked about the collections in the next 2 months. So that means there were no bad debts. And they have specifically mentioned also, right? I know what you're talking about. Credit sales and bad debts could be possible, but they have mentioned 75% of the credit sales are collected within 1 month and the balance in the second month. Okay. And to your point of 20 or 40, why 40? If my cash sales is 20%, in the month of the sale itself, it is 20%. The rest of the 80% is credit. 80% ka 75% is how much? Can you please check, guys? 75% of 80%. It is 60. Am I correct? And then remaining 25% of 80% is 20%. This is how we are getting that number. Guys, can you please double check? Let me know, guys, if anyone feels other way around, we can double check. Smitha says purchase paid in the preceding month of the sale. So Smitha, they are not giving you the numbers for monthly purchase payments. Rather, they are just giving you a context that the purchases are amount to 80% of the sales. And of course, purchases would have been arranged. You have inventory before you sell, right? So you can't sell first and then purchase, right? So what they're saying is that, of course, the purchase would be the 80% of the sales, and that would be made on credit and paid for in the preceding sales. So we don't need to know. Do we really need to know when were the purchases made? No. What is matter to us is when the payments to the vendor is done. Karthik, can you please double check what you are saying? You can use a calculator. Yeah, I can see now you have realized. Okay. No, that's fine, Karthik. That's absolutely fine. Absolutely fine. If anyone feels that there is a typo error, there is a please stop me. Karthik, that's absolutely fine. I think it would have been better that we corrected something now than realize later on. So that's absolutely okay. So if anyone feels that something is wrong, just stop me over there. Okay, great. So guys, Smita, you are okay with the purchases? What I needed to know is when I'm making the payment to the vendors. I don't need to know when the purchases might have made 2 months before. Because purchases would be made first, then it will be sales. And unless and until you have inventory, how will you sell it? I would not say that. You are talking about Jan purchases, 80% of web sales. Uh, okay, technically, if I just literally interpret that, yes, purchases amount 80% of the sales are made on credit and paid for the month in the month preceding the sales. So I think that part I'm focusing on. You're okay when you're reading the first line and interpreting that, that's fine. Smita, that's okay. So for example, if you're talking about in the month of April, by your logic, Smita, in the month of April, what would be the payment to the creditors? In the month of April? Everyone can reply. So in the month of April, the payment to the creditors would be 60,000 ka 80%, 48,000, right? So this is how we will be following it. Okay, good. Everyone is clarifying that. That's absolutely wonderful, guys. Now, the firm has 10% debentures of 1,20,000. Interest on these has to be paid quarterly in January, April, and so on. So I think our period is April to September, so we have to be careful. I think probably we are talking about April and July, right? I'm looking at the comment at the query of Bandredi, but Bandredi, we are not segregating the cash and credit sale for the purpose of computing the purchases, because the information was 80% of sales, not when 80% of the collections, right? Don't do that. Okay. Yeah. The firm is to make advance payment tax of 5,000 in July, so that needs to be incorporated. The most important thing, what's your beginning cash balance? Given to us as 20,000, which is actually a minimum desired level of cash balance. That's very important information for us. The company needs minimum desired level of balance of cash balance of 20,000, and any surplus or deficit is made up by temporary investments or liquidation of temporary investments. What we are talking about here is any cash surplus deficit is made by temporary investment or liquidation. So that means if you do not have enough balance, sell your investments. If you have surplus, invest in temporary investments. Everyone okay, guys? Can we start working on this now? What do you think in terms of the collections of the debtors? How should we plan? We know this, right? M+1, M+2, and so on. And what we need to calculate is the collections for every month. Can you tell me if you have to calculate the debtors, the sales over here? Can you please tell me what exactly you would be needing? I mean to say, basically, which month sales you should start your discussion with? Can anyone tell me? If we are starting with April, the cash budget, which month we will be starting our discussion with? Okay, everyone, Karthik, Siddharth, Anita, everyone is like saying February. I think that's absolutely amazing, guys. I think you guys are applying your logics fantastic here. Because we are talking about M+1, M+2, but for April, M would be April, M+1 would be March, and M+2 would be Feb, right? Am I correct? Smita, I'm not sure whether the January sales will be required, right? Your M+1, M+2 actually talks about the aspect of April as in, right? So let's do this. Let me just help you to kind of do this calculation. We can do this exercise together. And I want this, and I want this interactive. I want everyone to be with me on this. What we are calculating, guys, here right now, we are working on a little bit on the collection of debtors, or rather collection from debtors. And I think what we can mention here is that we were talking about 20:60:20 in terms of M-2, M-1, and M. Am I correct, guys? Now I'm using -2, -1, and M because everyone agreed that okay, it's like that's how we are calculating this. April, May, June. So when we talk about M-2, guys, so we are talking about the numbers from the Feb month, right? 20%. Am I correct? What do you think, guys? Should we talk about 20% of 1,20,000? Gayatri says, why February? Gayatri, because they have given us now that, so imagine February credit sales will be collected when? If February credit sales will be collected in March and April. The January credit sale will be collected in February and March, and we are creating for the month of April onwards. So we are taking 20% of Feb data. Feb data, 24,000. Similarly, are we taking 60% of March data? 84? And the current month, that is 20% again. Cash sales, that is April sales, that is 20% again, guys. Any thoughts here? How much is the cash sales, guys? 16,000, I guess, or 80,000 to 20%. Pooja says, why M-2? Pooja, because we are starting from February. February's collection would be in March and April. If I am in February, I will be looking at March, April. So that will be M+N+2. But if I am in April, I have to look back. So let us do one thing. We segregate this discussion at a little bit of a bottom here. We're talking about this as a cash sales. So because technically speaking, there is no collection from debtors here, right? So what is the collection of debtors for April, guys? 108. For the month of May, what's happening here? Yeah, Karthik, absolutely correct. So total 124, including a 1,08,000 debtors collection. What about May? In the May, we will be having a 20% of March sales, guys. And March sales are 1,40,000. Does it sound to be 28, I guess? And 60% of April sales, that's 48. So we are looking at a 76,000. And again, the May's month sales will be like cash collections will be 12,000 itself. Guys, I hope everyone is with me. Okay, Bandridi wants to see a question to take a snapshot. Okay, that's fine. That's fine. Give me a second. Anyone who wants to take a snapshot of the question, actually, that's a nice idea. Can do that now. Anyone who wants to take a snapshot of the question itself. Okay, so coming back in the month of June. Now, in the month of June, we can attack the April sales. April sales 80,000, 20% is 16. Now we can be a little quick, guys. I think you guys are understanding this, so it's good. May sales 60%. So May sales was 60,000, 36. Is everyone with me on this till now? Everyone with me on this? And June sales are given to us as 80,000. So 80,000 into 20% is 16. So that's cash sales. So mind you, cash sales are 20% of the current month. So what's happening for July, guys? July, we again start from May. So 16 to 20%, 12. And 80,000 to 60% is 48. Is everyone okay? Why I'm doing M minus 2 and M minus 1? Otherwise, you can apply minus 2 means 2 months prior. And again, the July month sales are 1 lakh, so 20,000. Smitha, what is the confusion? Smitha is saying, can you explain from Smitha? What I'm trying to do is I have noted down month minus 2, month minus 1. That is your debtors, and the current month will be cash sales. So April ke liye minus 2 will be February, minus 1 will be March. Similarly, May ke liye the minus 2 will be March and minus 1 would be April. Smitha, can you confirm if you are with us? I think numbers can puzzle you guys, but keep it simple, guys. And that is why what I'm doing. Basically, I'm focusing on this top 2060 of the last 2 months. Just focus on 2060 of the last 2 months. Smitha, are you okay now? Got the point? Similarly, for the month of August, guys, what is the sales of June? 80,000, right? And sales of July is 1 lakh. So we'll do 80,000 into 20%, 16,000 here. And 60% of 1 lakh is 60,000. That's 76. And the sales itself for the month of August are 80. So we are looking at another 25%. That's cash collections here. And then we are down to the last month, September. We'll focus on July and August sales for credit sales. So it's like 1 lakh and 80,000. So that gives us a good 20,000 and 48,000. And hence my cash sales for the month of September, we're talking about 12. Yes, everyone okay here? Okay, I think what we can also do here to make our work a little easy, why don't we actually note down at the bottom one more thing? What about the payments for purchases? Let's make a note of that also. Payment to vendors. 80% of the next month sales, guys. 80% of the next month sales. 80% of M plus 1. That's given to us. So for example, in the month of April, it's 48,000. In the month of May will be 64. In the month of June, it will be 1 lakh into 80%. July, it will be 80 into 80%, 64. In the month of August, you need a September month sales. So 60,000 into 80%, that's 48. Now I am interested in a September month. Now you need October month sales as well. October month sales is now useful. 1 lakh into 80%. 1 lakh into 80% is 80,000. So guys, I have kind of given you a good jinx of it that, how we are going with this. Everyone with me on this? This part is clear to everyone? Guys, anyone who wants to take a snapshot, please do it right now. I'm again going back to the other presentation. We will be kind of working around the entire cash budget now. Everyone with me till this point? I hope you guys are getting each and every number here. Yes, Gayatri. See, Gayatri, I think the from the language perspective, when you are saying that the month of April, the purchase payment will be made in March, look at that way that they have given just there. And I think this is the same question which Smita asked earlier. This is more from a language perspective, could be confusing. They are just telling you that 80% of the payment was in the previous month. But the actual purchase may have been done even prior to that, right? Because the vendor may have also given you some time. Is this fine? So Gayatri, I hope that makes sense. So anyone who want to take a snapshot, I hope you guys have taken that. Again, this is another way to look at that question, guys. How to make, I have done like most of the workings are on the slide itself. Rest of the stuff we can just work around now together. So when we go back to the cash budget, guys, now we know the cash collections from debtors, we know the cash sales, we know the cash payments of the vendors. Now, what we need to plot is other stuff. Let's, for example, they're talking about a lot of wages and all, right? So I'm sure that in terms of the wages, it is, any idea, guys, when we are paying these wages, in which month? What do you think? Are we paying wages in the respective months? In the absence of any information, they've given the wages for every month here. Karthik 6, why M1 is not clear for calculation of purchase? Karthik, because again, M1 is like M plus 1, right? Next month's. What I'm trying to say is that the timing of purchase, right? We would have paid in the previous month, but the actual purchase may be even prior to that. That's what I was explaining. Smita says, can you explain how did you took 20, 60, 20 at the top? Smita, in that case, the third 20 was the cash sales. See, if you are looking at the current month sales, then we are talking about the first 20 is the cash sales. But if I'm looking at the current month collections, then the last 20 is the cash sales. Smita, makes sense? I think a lot of you got confused in that. Let me just kind of again clarify you guys. So if we are talking about a particular month sales, let's say we are talking about April sales, how we are doing the April sales collections. We are saying 20% current month, 60% next month, and 20% next to next month. So that's M plus 1, M plus 2. But if I'm saying that April collections itself, only April month's collections, that means we are not talking about when the April sales will be collected, but how much collections will be done in the month of April. Here it is 20%. Then March will be 60%. Feb will be 20%. So hence I did M minus 1 and M minus 2. Smita, I hope now it is okay. I know you got the calculation part, I know. But I think what confused you was, now I clarified how that ratio I was taking. And also because the point was, one more thing I think I'm missing out here, just let me repeat for everyone. Guys, for any month, there were 20% cash sales and there were 80% credit sales. So 80% were credit sales, and the credit sales collection pattern was 75% of 80%, 25% of 80%. So that comes out to be 60% of total sales. And this comes out to 20% of total. So I think this is probably everything now. I can't go much more detail than this. Some of the people who are not yet clear now, it must be clear absolutely, because the entire GAN of the sales and the collections is now on the slide. Okay. So again, to summarize, what we did was we did a good collection of data. I think you can look at this way, the way it is being solved. But again, the only thing is that we did not have to plot all the month sales in our working, right? So what we have done is like made a column in the month of April, March as well, and then linked every month sales here. So 1 month, 2 month, and the total collections. So basically, what is happening in this case is, let's say in the month of March. So we're talking about like this in terms of the calculations, right? So what we're talking about is 84,000 coming in from the month of March itself, and then 24,000 is coming from the Feb itself. So that's how kind of flows goes on. Yes, Karthik, I agree with you. Okay, so this is what we have already done. So let me not repeat this. So let's work on the budget now. Let's work on the budget now. And I will walk you through with the individual month here. So what's happening is we started with the beginning balance of 20,000, but do you agree that every month's beginning balance will be 20? If I say every month's beginning balance have to be 20, do you agree with that? Because it is mentioned in the question itself that the 20,000 is a minimum desired level of cash, and you do not have any surplus or deficit. That's anyways given to us. So there is a 20,000 beginning and every month. We will see how that beginning will be arrived though. Okay. So everyone, okay, guys, this is what we did. Cash sales and collection from debtors. We have done this 16,000, 1,08,000, 12,000, 76,000. All of you have noted this down. So my total cash available for the month of April is 1,44,000. And the payments, wages we noted down, 48,000. Salaries, same month, 9,000. Interest on debentures, mind you, we said April and July. And tax payment was only in the month of July. So we have a total payments now. So we have a total payments of 60,000 and total cash available of 144. In terms of understanding the approach, what is the kind of a surplus we are looking at? That means we are actually having in the month of April, actual balance is 144 minus 60, 84. And since we needed only 20, we are saying that, okay, that 64,000 is a surplus here. So 64,000 is a surplus here. So what we need to do is we can invest that. And that is why you could see that we are talking about investing the 64,000 surplus. Is everyone okay with April? Can we say the same way the rest of the months can be quickly worked around? We have done all the calculations, just plotting the numbers here. Just that what I would like to just focus on is, let's say we move on to a month which is month of April or May or June. In the month of May, we are still looking at that, yes, my 1,08,000 is cash available, and 72,000 is what we are looking at in terms of, give me a second, In the month of 1,08,000, 72,000, that's still okay. 36,000. We are still on the surplus side. But I am worried about in the month of June. Total cash available is 88, including the opening balance, mind you. And the total payments are 90. Guys, 88 minus 90 is how much? Negative 2,000. And since we need 20,000, by any chance, how much security, how much investments we need to sell? 22,000 here. So 22,000 investment have to be sold to arrive at 2,000 balance. 20,000 balance. Because 2,000 negative is the current balance, guys. Everyone okay here? If you look at the June month, are things better for July? Slightly better. The July month is slightly better. The only problem is we still don't seem to have 20,000 because 1 lakh minus 82 is 18 here. And since we need 20,000, that means we are looking at least 2,000 to be sold off. 2,000 investment have to be sold. Guys, everyone okay with this entire example? Any questions? Let me know, please. I think same is the scenario with quite discussion on the month of September also. Because 1 lakh minus 89,000. 1 lakh minus 89,000 is 11. So that means you need to sell 9,000 investments to get 20. It's a good, I would say, comprehensive example on the cash budget. The only thing is I hope some of you are getting a little stuck in terms of the examples or the dates rather, the workings. Other than that, it should have been okay. All okay, guys, till this point? Okay, Karthik says we are projecting this. So instead of selling investment, why can't the April or May month surplus is adjusted for this deficiency of June? Karthik, do you remember the example I gave you from one of my corporates, how the 5 months return was 5 days return was beneficial? So Karthik, do you agree that probably we are talking about that the temporary investments would have given you some benefit rather than keeping the cash idle? That's what I mean to say. Karthik, is it okay? Neha has a question. Why are you skipping to the next months? Neha, because we have done all the calculations already on the other slide. These are just number plotting here. If you have any doubts, please let me know. Any other questions, guys, from anyone? We have done the collections from debtors. We have done the cash sales. We have done the payments of the vendors. Wages and salaries is given to us. We talk about the interest. We talk about the tax payment. So I think all the information has been touched base upon us here. Any questions? Neha, please let me know if you have any doubts in any of the months. I can go back. I was basically highlighting the months where there is a deficit. Because surplus, anyways, you are investing, right? In the deficit, you need to be careful. You have to sell that much of investments. And that's what Karthik was discussing right now. Prabhas is saying cash budget is very interesting. Neha, one more time, I'm checking. Any month you want to ask, anything you want to ask in terms of this illustration, can we move on elsewise? May and August. Okay. Neha wants to get a clarification on May and August. Neha, you are comfortable in terms of the calculations of cash sales collections. So total cash available is 1,08,000. So that is fine. Purchases we did 64,000. Wages and salaries is the information is given in the question 8,000. So that means total expenses is 72. Total expense is 72. Total cash available is 1,08,000. So my simple question to you is, how much is the balance you have for the month of May? For the month of May, we are talking about 1,08,000 is the cash available with you, including opening balance. 72,000 is the cash payments. So 36,000 is you are having. Now, since you need to have only 20,000, you are investing surplus 16,000 here. Surplus 16,000 can be invested. So Neha, is it okay now? 36 may say you can invest 16 and we still have with you 20. Okay. Smita, I think your question also I simultaneously answered. So for example, in the month of April, you had 64,000 surplus, right? You must have taken some kind of a temporary investment in terms of either a, let's say, short-term fixed deposit or any other investment. Similarly for May, 16,000. So look at this. So Neha, Smita, both of you, what has happened in the month of April and May here? Both of the months you have kept aside 80,000 already. So what is happening is you already kept 80,000 aside. In the month of June, you needed 22. So यहाँ पर 80,000 you have already kept aside. Out of this, you can use 22,000. You still have surplus. In July also, you wanted to use 2,000. That's fine. You still have surplus. That's fine. You had parked that investment. I think that's a very good idea actually. Smita, to your point, you guys can create a column of a net surplus or deficit or net investments. We can do that. That's actually a very good point. So let's create a separate row at the bottom in terms of, I just need a quick space here for this. I'm just kind of making some space for so that everyone understands this. And let's say we make a net investment with us, which could be temporary in nature. That's fine. So for the first month, or I would rather say the net investment is in terms of cumulative. I'm talking about cumulative net investment. So it is 64,000 here. It is 80,000 here. 80 minus 22. 58 left. 58 minus 2. 56 left. What has happened in the month of August? Then there are another 35,000 surplus left with us. 91. And then 9,000 with us. Extra 9,000, which is we have to sell, right? So 91 minus 9 is 82. So at the end of the day, I'm still having my temporary investment at 82. Everyone clear here? So I'm just kind of created a cumulative net investment coming out of every month. And I think this answers Karthik, your question as well. So this much money had been utilized or probably getting some returns. Karthik says last row, total cash needed. Karthik, the idea here is, okay, how they have calculated is, okay. Karthik, what were the total payments? 60,000. What is the balance you need? 20. So you actually need only 80 now, but you have 144. Karthik, got it? Anything else? So guys, can we move on? So let's move on to the next illustration, guys. Another one on the cash budget. Now, this is also a very interesting one, and let's have a crack on this. But I want everyone to be very proactive on this one. I want everyone to be super proactive on this, please. Okay. Now, what is the information given to us in this one here? They are talking about we have to create a month-wise budget on receipts and payment basis for the 3 months now. Thankfully, we only have 3 months. It is anticipated that working capital at 1st January 2019 will be as follows. So they're giving us the working capital discussions in terms of various components: cash in bank, short-term investments, debtors, stock, creditors, dividends payable, tax due, and so on. And they've given us budgeted profit statement and budgeted balance at the end of each month. And what are the months they are giving us, guys? Jan, Feb, March. And those are the 3 months we are talking about. The budget has to be made for 3 months, Jan, Feb, March, because we're talking about 3 months ending Jan, Feb, March. So can anyone tell me what exactly do we need now? I think we need basically what we did in the last question. The cash collections from the debtors and the cash payments to the vendors. And in this case, they've given us a lot of information in terms of sales, cost of sales, gross profit, and so on. Now, in terms of the receipt from debtors in every month, how can we do the calculation? Can anyone tell me? Based on the given information, how can I do the quick calculation from collection from debtors? I think I can probably give you a hint that you can simply think of a debtors account as a T account. You have the beginning balance with you probably somewhere given to us. You have the sales given to us. You have an ending balance given to us. What you need to just calculate is basically the balancing figure. And the balancing figure here is nothing but your cash or bank. So is everyone with me on this? Can we do that quick calculation of collections from the debtors based on this sales number and based on these debtors number? Just make sure that we don't have any other information given to us with respect to any bad debts and so on. So Neha, Hitesh, Smita, you guys are okay for the collection from debtors? This is how we'll be doing it. In fact, let us have a look at the collection of debtors only right now. I want everyone to just have a quick checkpoint at the bottom half of the table right now. We will look at the top half in some time. I will explain you the top half in some time because we are yet to discuss the vendors. I want just everyone to look at the bottom 4 rows. We have opening balance of debtors, we have sales, and we have closing balance of debtors. Everyone okay with the collection of debtors here? Yes, absolutely, Karthik. You are on the top of your game. So let's move on. So if everyone is okay with receipt from debtors, Gayatri, in this case, there is no information given to us for credit or cash sales, right? So these are credit sales probably, and we're just plotting that in the debtors account. So there is no separate information given for cash sales. So the the entire sales are plotted in debtors. That's what we have done. 2100, 1800, and 1700 taken from P&L account. Okay, so guys, what about the vendors, right? For the payments to the creditors, unfortunately, we do not have the sales given to us or other purchases, right? What we are given to us instead is cost of sales. But for vendors, do we need purchases, guys? Am I correct or am I correct? We need purchases. And what do you understand by cost of sales? Are we okay to say that, okay, cost of sales or cost of goods sold is opening stock plus purchases minus closing stock? Can we derive purchases formula from COGS itself? Is everyone clear on the top equation here? So purchases will be equal to COGS plus closing stock minus opening stock. Everyone okay to that extent? Okay, so once you can calculate the purchases, then again we can use a T account here for creditors. because they have given us the creditors beginning balance, ending balances. So what we need to do is majorly, and mind you, for the beginning balance, there is a top information anyways available, 1st January 2019. So your beginning balance given to us. I think purchases you can calculate from COGS. Ending balance given to us. And what we need to do is calculation of the payments here. So let's do this. First, we are talking about calculation of purchases here. So we're talking about the January cost of sales. We add the closing stock and we reduce the opening stock here. So 1635 plus 1200 minus 1300. What you are getting at the end of the day is purchases, guys. You're getting purchases 1535. Right? Similarly, for the Feb, we have cost of sales given to us in the P&L 1405. The stock becomes 1100 and 1200 automatically. I think everyone agreeing with me that the closing stock of the January becomes the beginning stock of the Feb, and so is the case for March. Everyone okay to that extent? I hope no one has any doubt on this part. Right? Just give me a second. I'm just trying to fix this here. So the ending inventory of the 1 month is majorly going to be your beginning inventory of the next month. Unless and until you expect some thieves came towards the end of the year on 31st March and did some dance party. We did not assume that, right? So ending inventory of February is the beginning inventory of March. So if you have calculated the purchases, adding your creditors of opening balance and further reducing your opening balance, you will get the payments to creditors here. The payment to creditors can be also calculated here. Everyone okay here, guys, on this slide? Any doubts, please let me know. Please let me know if you have any doubts. Is everyone clear from the perspective of receipts from debtors and payment to creditors? These two aspects are clear to everyone. I think because this is very important in terms of the overall working of this particular illustration. Now, we also talk about some other balances given to us. That will be important, right? Let us look at them one by one. The first of the balance is given to us is short-term investments, 300 beginning, 700 at 31st January. Then probably there is a purchase of investments of 400,000, 4 lakhs. And suddenly in 28th Feb, there is nil. That means there is a sale here. And then there is another purchase of 200. That's another purchase. Wow. So then we are talking about after the short-term investments, I think we're taken care of debtors already. We're taken care of in terms of the stock adjustments. We can also look at other creditors, which thankfully remain constant to us, 200, 200, 200. That's good. Dividends payable, mind you, was 485, but somehow I can see that dividends were paid in the month of Feb. I'm looking at the balances of different accounts, which we will be kind of considering at the time of preparing the cash budget together, guys. And I want everyone to be super active here, by the way. Everyone to be a super active one. So what we are left with just one account, plant. We're talking about 800. And we are just ignoring the depreciation as given in the question itself. Seems that another purchase and some sale. So this is a purchase and there is some sale here of 50. From an analysis of all these accounts, can we now go to a cash flow or a cash budget to incorporate all the receipts taken together and all the sales taken together, all the payments and purchases taken together? Can we do that now, guys? Let's carry this information to the cash budget for 3 months. So our opening balance given to us here is 545. That's what we start from. We took the debtors collections 2070. That gives us the total amount. Payment of the creditors were calculated, guys, from the previous slide, 1645. Expenses 255. How we are calculating the expenses, guys? Can anyone tell me? How we are calculating the expenses side? Any thoughts? That's another interesting thought, right? How we are calculating the expenses. At the bottom, can you see there is a depreciation of 60,000 is included in the budgeted expenditure? So all the expenditures which is given to us, 315, 270 and 255, we have to reduce 60 here. Yes or no? So for January, it will be 255, for Feb, it will be 210, and for March, it will be 195. That's what we're doing here. So depreciation of 60,000 is ignored. And then someone said the plant is purchased in the month of Feb, but it was sold in the month of March. So there is no adjustment in January, right? Purchase of investments, yes. Purchase of investments, yes. Because we were talking about investment account increase from 300 to 700, mind you. Look at this. The investment account increased from 300 to 700. So that 400 is taken care of. And hence, my total payments is 2,300. And we're talking about the closing cash balance of 315. That becomes the beginning balance of the next month. And the same logic prevails. Your debtors collections. Mind you, in the month of February, though, there is a sale of investment because suddenly investment is 0 from 700. So that we need to consider. That's okay that everyone is comfortable in collection from debtors of 1900, but there is a sale of investments as well. Creditors and expenses are sorted. I talked about the purchase of equipment, that's sorted. Dividend of 485, we talked that yes, in the month of February, the dividend is 0 now. Dividend payable was beginning 485, ending of January 485, but in the month of Feb and March, you can see here that dividend payable is gone 0. So that means the payment happened in the month of February here. And hence, we are looking at a 65 balance that goes to the March. And accordingly, March numbers can be easily plotted. Any questions from anyone, guys, in terms of this budget? Any questions from anyone? Please let me know. Karthik 6, what about the tax? Wow. Karthik, what is the tax due? Beginning, ending, all amounts are same, right? So tax payable remain same. So no movement in the tax account. Everyone okay, guys? Plant part again. Okay. Siddharth, in the plant, do you agree that they have mentioned in the bracket depreciation is ignored? So we are not worried about the depreciation factor here. That's what the question tells us. What was the beginning in the number of the plant? So if I want to prepare plant account here, what was the balance in the month of January? 800. Here we have 800. In the month of Feb, you have 800 carry forward. The ending balance is given to us as 1600. Probably there is an additional 800 purchased here. The month of March, the 1600 becomes the beginning balance. Ending balance is 1550 though. That means there might have been a sale of 50 here. So that is it okay? Plant part explained. Guys, everyone okay now for this one? I think this one was much easier than the last one. The only thing is that you needed to just keep a track of individual accounts as far as the other movements were concerned. So like you're talking about the plant, you're talking about the investments. So majorly these two were something we need to be considered. Okay, guys. So I think let's do one thing. Now that we are done with this, I think it's almost 7:26. Let's take a quick 10 minutes break, guys. And on the other side, we'll be quickly talking about the cash budget for the long period. But first, let's take a quick 10 minutes break. Hope everyone had a much needed break after such a mind absorbing first half. And I'm sure, firstly, I would like to definitely congratulate here. I think since the time we started the cash budgeting, I can see a lot of discussion has been to and fro. And that is actually a very, very good aspect. And Karthik, I somehow had this apprehension when you asked that query that you will yourself find the answer. And I could see that coming up. I was so spot on this time around. Okay, Bandredi says, should we ignore depreciation in every sum? It's a non-cash or if only mentioned in the problem? Bandredi, it depends on the requirement, right? So for example, in this case, in the last question, if they're talking about ignoring if they have not given the ignorance of the depreciation, they would have given you the accumulated depreciation account. Then the problem would have been a little longer. You would have to create T account or you would have to track the mechanisms of both the fixed assets, and also the depreciation. And then they would tell you how much assets cost worth were sold. So there would be like too much of information given for that. So probably I think take it question by question, right? Don't take a general assumption. Great. So guys, continuing our aspect with respect to the cash budget for long period here. I told you for the shorter period when we talk about or rather month by month budget, we generally follow receipts and payment, but for long term, we are talking about just like we prepare for the cash flow statement indirect method. So we are talking about we are taking the cash and bank at the beginning of the period. We're doing some adjustments. We start with the profit figure. We add back the depreciation. We also add back the sales proceeds from assets. So the idea is that what we are trying to understand is that we are starting from the income statement and we are incorporating the aspects of other areas which are not there in the income statement. Because when we talk about the profit and loss, that's okay. We have profit before tax over there, which has to be adjusted with the depreciation added back. But we do not have any sale of proceeds, so we'll be adding them up. We do not have the financing activities, we have to add them up. Any reduction in working capital like we did in the cash flow statements. That's what we are talking about. Any dividends and taxes payment because you took profit before tax. I think Karthik, this is for you. We're talking about profit before tax, so you reduce the tax to be paid. Cost of assets to be purchased from the capital budget because that is again part of the investing activities, doesn't come under profit and loss. Shares or debentures to be redeemed, again financing activity, and again the cash flow statement working of the increase in working capital. Prabhas, what I was trying to answer was to Bandredi's question. Imagine that they are giving you any question where you have a balances of the assets, balances of the depreciation, but when they are giving you any sale or purchase, especially for sale, they have to tell you, right? The asset which is sold is having how much of, how much balance of accumulated depreciation. Only then I can help you on that. That information has to be given, right? So basically what we will be doing is you can transfer that accumulated depreciation on that asset value to a separate asset, a separate account, asset held for sale or asset sold account, right? Prabhas, I hope you got that. So basically we need to then remove the elements of asset sold both from the fixed asset account and also the accumulated depreciation account. Okay. So guys, as I was talking about this, there is a small illustration basically where we are talking about the cash budget for the longer period. But I want this as a homework for you all. I want you guys to please go through this illustration as a homework in terms of the long-term cash budget. It's not at all tricky, trust me, and that's why I want you guys to try this out. We are given the profit and loss. They're given a net profit here. They're also given the expectations for year 3. I can quickly do a quick summary for you because what they're asking us is that what will be the cash flow from operations for year 3. And what they have given us is year 1 and year 2. So they're talking about sales are expected to be 12 lakhs. They're talking about other expenses will increase by 50 lakhs. And they're talking about assuming the sales and the purchases are in the cash terms and the closing stock is expected to go up by the same amount as between year one and year two, and no dividend being paid, and they're talking about 75% of the cash generated to service a loan. So a lot of information is given to us, and this is where we are talking about based on the year two, we move on for year three calculation. So what we are doing is, let's say, first of all, we are talking about a projected P&L account from year two to year three. This is what it is given to us, right? So we're talking about a 10 lakhs in rather 10 crores in year two, but the expectation given to us in the question is 12 crores. So these numbers are in lakhs, of course. So 12. Then we are talking about everything else remains the same, the miscellaneous income and all. Now, the most interesting part is they were talking about the closing stock is the only point I would like to highlight here is the third point in the paragraph. The closing stock is expected to go up by the same amount between year one and year two. And in what we have done here is we have calculated the material consumed. And how did we get that? How did we get that, guys? Can anyone tell me? How did we get the materials consumed in this case? 350, 420. So how are we talking about this 350? Can anyone tell me? How can we calculate the materials consumed for year two itself? 350. Who will tell me this? Let's see who will try to answer this one. You can do all your calculations in terms of opening stock, raw materials, stores, closing stock, everything is given to you, right? Just try to do your calculations here. One thing they have given you in the additional information is that your raw materials are in stock. How can we calculate that material consumed in year two? I will talk about year three as well. But how can we talk about in year two specifically? Yes, everyone know the formula for the cost of goods sold, or in terms of the raw materials, what will you get if I add opening stock plus purchases minus closing stock? We will get raw material consumed or not? Will we get raw material consumed? So what is the raw material consumed given to us? 100 in terms of lakhs, 400 in terms of purchases, closing stock 150. So that's how we are getting it. Simple formula. Everyone. So if we decide or we kind of calculate how much does this in proportion to the sales, sales is 10 crores and we are looking at 3.5 crores. Can we say that the raw material consumed is 35% here? Can we say that? Is everyone with me on this? Accordingly, can we say that since we are talking about the same pattern of the stock, because they are saying that year one and year two may the jump, the year three may it will be also the same. So can we assume that okay, that 35% can be applied to year three sales, and hence we get material consumed for year three. The same logic goes for the stores as well. Same logic goes for the stores. We calculate 12% of sales in year two and year three. I hope everyone with me. So I'm just kind of touching base the important point. Otherwise, later on, you might get stuck here. Everything else is very, very straightforward, guys. We have to just kind of do the calculation part. So we have a manufacturing expenses and so on. So 160 is my manufacturing expenses. This is like looking to be 16%. So that is again the same logic with respect to the sales. 16% of the sales. Other expenses given in the question is plus 50. Depreciation remains same. And net profit is 204 accordingly. And since this is only a projected cash flow, we need to calculate the projected income statement. This is what we need to calculate, the cash flow. So we will actually start with this profit and add back the depreciation. And then we are talking about the cash required for increase in stock. We are talking about that is 254 is my net cash inflow. Why we are talking about this, guys? Cash required for increase in stock. Cash required for increase in stock. That is something given to us anyways. Am I correct? Because the information was closing stock is expected to go up the same amount. So if this is a more of a working capital change for us. That's the only information we have at hand. We do not have any other information about debtors, creditors, and so on. So basically, net cash inflow is 254, and they have given us that 75% of this will be available for servicing the loan. That's what you get. Now you can try this illustration on your own. I have already spent almost like 8 to 10 minutes just explaining some key parameters, and that is something you should be fine, right? Although I personally feel that the monthly cash budget could be a more like a question which is generally asked, but you never know. I think you should be prepared for both. You should be prepared for both, whether it is a short term or long term. Okay, guys, I want to start the next aspect in terms of managing cash collection and disbursements. Very, very important. So a lot of things which we are talking about in terms of what happens traditionally in the industry and what happens currently in the industry. Let's talk about this. Yes, every organization would want to receive the payments early and defer the payments. I think that's what very interesting part, right? As far as your collections are concerned, you want to accelerate it, but when it comes to your payments, you want to defer it. But guys, do you agree? You would still want to be within the credit limit, within the credit period? Do you want to defer the disbursement? But if you breach your credit terms, then probably your reputation will be lost. You may have penalties. You may have problems in the business. Right? So what we need to understand is majorly when we talk about the realization of funds, first of all, from the sales itself, you provide a credit period to the customers, let's say 30 days, 60 days. But when they actually issue the check to you, the check will take some time to reach to you. You will deposit that check. It will take some time for clearing. So there is a huge type of delay. Now, I know some of you might say that, okay, sir, these days it is mostly RTGS, NEFT. That's okay. As I said, I started the discussion by saying it's like more of a traditional way of doing things. In some areas, in some companies, they still may be doing this. Of course, the modern day banking has definitely removed all this, and we will talk about that. So basically what we're trying to say is the delay here is actually relates to 4 types of float. Float means it's like a gap. First is billing float. Now this is more of an internal, right? We have done the sale, but probably you are so lazy in mailing your own invoice. Wow. That is a billing float because you have taken time to raise the bill. Mail float. Now this is something beyond your control. When your customer kind of dispatches the check to you through whatever, India Post or any kind of a carrier. So that delivery agency will take some time to bring the check to you. That's mail float. And let's say you have received the check and you are busy in your chai and samosa and probably the check was in the drawer and you realize 2 days later, okay, you have to submit in the bank also, right? So probably, sorry, I just took an example of a tea and samosa at the wrong time, I guess. But anyways, so we are talking about a recording and depositing a check after receiving. So if we take this time, I think it's our fault, right? But what is beyond our control, I would say, 2 types of float, mail float and bank processing. Because if you deposit the check, the bank will have its time, right? Everyone understand that, okay, every day, most of the branches request you to deposit the check. Some branches are 11 a.m., some say 10:30 a.m., so on. So if you deposit before that, probably by the next evening you will get the clearance. So in most of the times it will be like 1 to 2 days at least. Is everyone agreeing with me? So two floats, billing float and check processing, are your internal delays. Mail float and bank processing float are not in your hands. Now, obviously, you want to expedite the collections. That's absolutely correct. So the idea is that either you start working out your your own internal processes. Let's say we are talking about issuing the invoices quickly. Let's say you build in a software, as soon as the sale or the goods are dispatched, your invoice is reached, or even emailed to the customer. Or we are talking about reducing the time lag between a customer pays the bill and check is collected. So of course, that's a part of collection management. Now there are a few things here which we talk about, which generally had help. Now I'm talking about even before the online banking came in, even before the NEFT and RTGS became too common. So one is concentration banking. There what happens is that you have one major bank at a headquarters with multiple collection centers or branches in different locations, which could collect the checks and deposits. So that means you are done away with the mail flow. You can tell your customer in the different city that, okay, this is the collection center, you can deposit a check there itself. You may say that, okay, this in the common day world, we anyways have branches of most of the banks everywhere. So you can directly tell the customer, even if they're not doing the online transfer, you can check that person, to deposit the check in your behalf. That's it. And that's what the companies do. But very interestingly is another system which came into picture was Logbox System, where it acts like a post office. Banks financial institutions provide the company services very similar to the post office box. Like they give you a kind of a drop box kind of a stuff where you authorize the bank at each location to pick up the remittances in those boxes. So customers will be given the instructions and addresses that these are the log boxes. Bank will pick that mail from those log boxes at a certain time in a day, or probably several times in a day, and deposit the checks in the company account. Of course, bank will do some charges. Bank will definitely charge you for that service. That's fine. But what will happen instead is that will eliminate the check processing float, which you were busy in having your tea and you did not realize that, okay, you had to deposit the check in the branch. That also is required here. Whereas on the other hand, when we talk about deferring the payments, we need to understand that, we are talking about the credit period similarly given to us by the vendors. How I can take that, into account. I want you guys, there is an illustration in your books, guys, with the illustration 9. I believe that it's the same number, right? Prachi Limited. Can anyone check this, please? Confirm me. We're talking about the illustration with Prachi Limited. This is a very interesting illustration. I have not covered it here, but I'm just telling you as a homework. In that, they're talking about certain days, what happens on certain days in a week: Monday, Tuesday, Wednesday, Thursday, Friday, when the check is deposited, when it is cleared, and so on. And they're talking about that how the float can be taken into advantage in certain scenarios. So they're talking about the uncleared float and so on. So guys, have you just referred to that illustration, please? Not now. You're not supposed to read this now. You can read this later on, but that will kind of make things much more clearer in terms of these types of floats. Okay, so please go through that. Thanks, Siddharth. Thanks, Karthik. So illustration 9. Okay, now moving on, as I said, we will talk about what had been the developments in the recent months, or recent years rather now, because it's like more than a few years, which some of these have been into existence. Electronic fund transfer specifically, quick transfer of funds, your balance, immediately you get the SMS from here and there. I think, I don't know how many of you remember, many years back, let's say 5, 7, 8 years back, if you are stepping out of your house and you forgot your wallet at home, you didn't have a choice but to go back, right? But to go back and pick up your wallet. I'm sure you would have seen your elders doing that. Now is the time, if someone actually, even if someone forgets the wallet, but actually carrying his or her mobile, You have all the facilities in terms of the online payments, UPIs, Paytm, and so on. Am I correct, guys? Things have changed drastically. So electronic fund transfer and other online payment mechanisms have facilitated the transaction so easy. Zero balance account. Now, this is more for relating to our discussion of Treasury Department. That you can agree with the bank that, okay, we want to keep a zero balance account. And you can, in fact, so most of the banks and financial institutions also have their securities, right? So marketable mutual funds and so on. You can have the arrangement with the bank only that if they have some surplus and if there is any balance that can be invested in those securities, when needed, those can be automatically sold off. Money market operations, as I said, this is something we have already discussed, right? That you could invest the surplus funds as deposits for some days and can imagine. Let me take an example that let's say a company like Whirlpool, I was giving an example. Let's say they have 6 crores in their bank account, 6 crores. They don't need any funds for 5 days. And let's say they negotiate a rate of 4.5%. 4.5% into 6 crores divided by 365 into 5. I'm getting 37,000 rupees. And if there are 2 administrative people of 15,000 salary in the company, someone who's looking after stationery, someone who's looking after tea, coffee requirements, do we agree that 5-day deposits will actually help them to pay the salary of 2 people or at least one person's 2 months salary? Do you agree, guys, that how that could be helpful here? Bandredi says, forgetting wallet doesn't pull me back, but forgetting mobile pulls me back home. Bandredi, I hope forgetting mobile, you are going back home only because of the Paytm and not for other reasons, right? Like probably you're not expecting any calls on your mobile, right? And especially parents at home. I hope you meant that only. So anyways, but jokes apart, guys, I was talking about that. Yes, many people would definitely go back at home with mobiles if you kind of missing your mobile and you're forgetting your mobile for some reason. Anyways, investing temporary cash surplus in market instruments, debt or equity, that's okay. Marketable securities. Here, of course, there could be some risks. So the study of investments could be important. Electronic cash management. So now this is something which is like more from a perspective of electronic cash transfer only. It's like you have some designated transfers and so on. Virtual banking. Now, I think, guys, I don't know how many of you have seen this actually. Let me ask you this question. How many of you have seen these ATMs without any person over there? This is very common for quite a long now. It's like more of a... I'm actually not only talking about the money withdrawal from ATM. I'm even talking about updating your passbooks. So there are certain banks who are moving into that direction to have some kind of a mini branches with absolutely no personnel therein or having absolutely minimum manual involvement. Even if there are a couple of guys, they're just there to fix the glitches. So let's say this Bank of Baroda, right? Their ATMs generally have a machine where it helps the customers to update their passbook also. So you're not needing any kind of a branch for that, right? So NEFT, you're using your MICR, I'm sure barcodes, you scan that and you pay. So that's part of the cash management, guys. So this is definitely help. Yes, Siddharth. So now we talk about briefly about management of marketable securities here. As I said, in terms of the marketable securities, when we are talking about surplus funds available, we could definitely invest them in short-term securities that could be liquidated. And I think we discussed the one example of that cash budget today already. But since there could be a risk element involved, refer to my lecture when we discuss about the cost of capital. I don't know how many of you remember that graph where the risk increased, right? Capital asset pricing model, let's say government treasury bills were the least risky. Deposits with banks. But then we talk about deposit with corporates and then we talk about the shares, right? So the idea is that when you are putting in this surplus money, you would be needing after 5 days, you would be ensuring safety, that you want to have minimum risk. One thing is for sure that you're not going for a longer maturity. And in terms of marketability, of course, you want to ensure that that can be sold with less cost and with no time. It should be instantaneous transactions, right? So this is what we are talking about here: safety, maturity, and marketability. Now, time for an illustration, guys. Time for an illustration. Quickly, I want everyone to be ready. So there's some information available in respect of Shri Bhakti company. On average, debtors are collected after 45 days. Inventories have an average holding period of 75 days. Creditors payment is 30 days. The firm spends a total of 150 lakhs annually and it is at a constant rate, and it can earn 12% on its investments. There, you have to calculate the cash cycle, the cash turnover, minimum amounts cash to be maintained to meet the payments, and savings by reducing the average inventory holding, inventory as in terms of the cash, by 30 days. So we have to discuss this one by one. So guys, can anyone tell me what is the cash cycle here? What is the cash cycle here? 45 plus 75 minus 30 here. That's the cash cycle given to us. Debtors 45 days, inventory 75 days, minus the creditors. Are we talking about 90 days here? Everyone okay? Now, if you're talking about 90 days or 3 months broadly, in terms of the cash turnover, can we say that we are looking at 4 operating cycles or 4 cash cycles in a year? We are saying cash turnover in terms of 4 cash cycles during a year. So if we're talking about 360, or let's say we're talking about 12 months upon 4 months. So what they're asking us is minimum amount of cash maintained to meet the payments as they become due. Who would like to answer this one? We are saying that the firm spends a total of 150 lakhs annually. So if we are talking about 150 lakhs annually, what does that mean in terms of our requirement? We are talking about annual requirements, but we are talking about 4 cycles. So every cycle we will be needing 37.5 lakhs. Do you agree, guys? Because there are 4 times the cash is churning, cash is rotating for us 4 times in the year. Is everyone clear till now? Guys, everyone okay till now? For point A and B, let me know. Any doubts? So we're talking about 3 months, we're talking about 4, and we're talking about 37.5 lakhs here. But then the question changes actually. The question changes that savings by reducing the average inventory holding period by 30 days. They're saying that, okay, change this to 45. And hence in that case, my total days actually become 60 or 2 months. Accordingly, my cash turnover will be increasing. So my turnover will be like more or less 6 times now instead of 4 times. So there are 6 cash cycles in a year. 6 cash cycles, guys. And will that require the reduction in my minimum operating cash? Because total is 150 lakhs. During every cycle, I'm using only 25 lakhs. So that means savings in the cash requirement every cash cycle is 12.5 lakhs. This is a very, very good analysis. Let me know if you have any doubts. What we did was we changed one of the cycles. We then calculated our cash cycle and accordingly the number of cash cycles in a year. And hence, we are talking about minimum operating cash is 25 lakhs. There, in terms of reduction in the investments, is 12.5, and the savings at the rate of 12% would be 1,50,000. 12% of only 12.5 lakhs because that's what is the reduction in the investment. Guys, any doubt till now on this illustration? All okay? Let me know if you want to ask anything. Any questions, guys? So it means more we reduce the cash cycle. So that, don't you think same we discussed for the operating cycle anyhow, working capital cycle? So you want more, so more quickly your cash can churn in the system, better it is for you. You have more revenues for growth, more revenue for investment. Shorter the cycle is always better, right? Be it operating cycle or a cash cycle. Smita has a question that I changed the inventory holding period to 45 days. Okay. Smita, so what's the question? They ask us now. Savings by reducing the average inventory holding period by 30 days. It was originally 75. So 75 minus 30 is 45. No? Based on the question requirement, question number C. They're asking you now that what will be the savings by reducing the average inventory holding period by 30 days. That was given in the question number C. Smita, can you see that? Neha, just to summarize, what did we do initially? We calculated a cash cycle, which was 3 months. That means your entire cash cycle is circulating throughout the year 4 times in a year because 3 months we calculated. And since you require a 150 lakhs, that is 1.5 crores every year, so that will be evenly required. So for every cash cycle, it will be 150 divided by 4, 37.5 lakhs. So at any point of time, for a cash cycle, you would need only 37.5 lakhs. Neha, that's okay. Now, what they said that what if my original inventory holding period was not 75 days, but rather 45 days? Then I recalculate my cash cycle. And this time my cash cycle was actually not 3 months, but 2 months. And what does that mean? That during the year, I will be having 6 cycles of that kind, 12 upon 2. If I'm having 6 cycles, with the 150 lakhs requirement throughout the year, I would need only 25 lakhs at any point. Because my cycles are repeating, right? 25 lakhs instead of 37.5. So do you agree that there is a saving here? Instead of 37.5, we are only requiring 25 lakhs and hence that additional 12.5 lakhs can be invested. So that 12.5 into 12% is 1,50,000. Guys, everyone okay now? So guys, let's move on now. Very important couple of models I would like to talk about in terms of cash management. Although this is more of a, I would say, models coming in from the history of finance, history of financial management, but you never know that you are being asked as a part of the question or a theoretical question. So it's important to be aware of them. First one is William J. Baumel's EOQ model. It's like EOQ everyone has studied, right? Economic order quantity in your inventory. We'll be also discussing that later on in this chapter itself. Now, what we are talking about here is that should we carry a higher cash balance? Should we carry lower cash balance? Here, the same logic is there. We have to decide on optimum cash level where the carrying cost, which is an opportunity cost, because if I'm carrying a higher cash balance, don't you think I'm losing on the opportunity to invest somewhere? That's the opportunity cost. And if I do not want to keep high cash, every time I need a cash, I will be either selling the securities or withdrawing the cash. Then I will be incurring some transaction cost. So the idea is high cash balance, opportunity cost is high. If the cash balance is low, then the transaction cost is high. So either your opportunity cost is high or transaction cost is high. So you need to model where you talk about optimum balance where the combined opportunity cost and transaction cost are minimum in combination. So we use the same formula here. Optimum cash balance is under square or under root of 2 into your annual cash disbursements or annual cash requirements into fixed cost per transaction, just like ordering cost. What do you do in the EOQ, guys? In the inventory model, you do 2AO upon C. That's what we are doing here. So we're talking about like U is your annual cash requirements in terms of disbursements or payments. P is your just like your ordering cost. Here we are talking about transaction cost. And your carrying cost is opportunity cost, which is like 1% per annum or per month. So it's like 1 rupee per annum or per month. So how do we decide per annum or per month, guys? If your requirement is annual, take this per annum. But if it is monthly, then take it as per month. Make sure that we use the same parameters. Now the idea is that this model definitely is based on historical models, and definitely all the historical models were based on some kind of an assumptions. And one should appreciate that, yes, even these models were made on some assumptions. Like you needed to know your holding and transaction cost. Not only know, but assume that they are constant. You need to know your cash needs during the year. So those are the assumptions this model used. Now, another model, very interesting one, is a Miller or cash management model. Now, we're talking about changes in the cash balance in a business can be happening frequently or less frequently. Well, let me give you a very, very I would say, academic example here, non-academic example. How many of you are aware, for years now, many households have this automatic cutoff with your water motors at your homes? Am I correct? How many of you have seen that? I'm sure some of your houses might be, in fact, having that installed for years now. What happens there, guys? Do you guys know how that system works, where there is a motor auto cutoff for your water requirements at home? The water which comes from municipalities. Anyone, guys, here who has such kind of equipments at home? Or have you seen such equipments installed at such certain households? So I just want to see if anyone has seen that system. No one has confirmed me yet. So I'm assuming that no one has seen that. Okay, Smita says no. What about others? Okay. Even if you have not seen that, guys, let me, okay. I think majorly students are saying that not seen. So guys, what happens is many households have this, let's say, so there is a water tank, right? So on the left-hand side, I'm just kind of talking about this is a water tank. So what will happen is, of course, you would want your water based on the water requirements. So you would want your water tank to be full. Now, there is a system. Let's say there is a gadget. This is an electronic equipment. What will he do? What will this equipment do is, it will basically place two transmitters, let's say on the somewhere on this level and somewhere on that level. What will this do? What will these trigger points do? As your water level goes to the minimum point, so minimum point is this one, it will switch on the motor automatically. And as the water tank fills the water, till the top of this level, the motor switches off. So it's auto cut. Hitesh knows it. Very good. Bandredi is like confused. Really? Do we have these gadgets? Yes, Bandredi. So guys, everyone got the interesting, I think, I don't know what the cash management model, but everyone understood the water motor model, right? Am I correct, guys? Interesting. I'm sure those of you haven't heard about this. I'm sure you guys might have found this interesting. You don't need to worry about anything, right? So Hitesh knows about it. Hitesh says when water reaches its maximum level, it stops filling the water. That's okay. And when you consume, when it again go down, it again starts. So your water motor needs to be connected to this equipment by some wire. That's okay. Now the Miller ore model is also kind of very similar. When we're talking about changes in cash balance occur randomly. So we are talking about some control limits. Upper limit, that is H, return point, Z, and lower limit as 0. Right? Or probably, if you're talking about Karthik says, I will search it on Amazon. I will buy it. Very good. Okay, so guys, I'm talking about this upper return point. Practically, like I gave you an example, right? I kept my lower limit of my water motor or water tank as a slightly up. I want to have some margin of safety here at the bottom. I don't want it to be empty. Similarly, you could keep a lower limit which is lower number than Z instead of 0. So now what is happening here is when the balances reach H, so that's my upper level. So we are talking about H minus Z is invested in marketable securities. Guys, everyone okay here? Because you want to keep a level till Z. You want to keep a level at a center. Neha says, probably I will ask my father to install such system. Neha, your father will say, who is your teacher? Tell me first. Okay. So anyways. So guys, everyone okay till the first point that if the cash balance is above, it reaches the upper limit. If you reaches upper limit, you will straight away invest in the marketable security so that your balance comes down to the return point. But when it touches the lower limit, some investments are liquidated. So that means when it touches the lower limit, you want to liquidate so that it again goes back to the return point. And when the balance is between these lines, there is no transaction that is required. I hope definitely water motor example help you to understand the Miller or cash management. But my humble request is in the examination, if you're writing a theory, don't give example of water motor, give the example of water, your Miller cash management model, please. But I'm sure you will never forget this now. Guys, everyone okay? Neha has an interesting question. How to write notes, practical subjects? Neha, quick, I think understand the concept, probably make short notes, crisp notes, but understanding is required so that if you want to elaborate that as part of theoretical question, could be helpful. And of course, your past year papers could be helpful, like what type of theoretical questions they're asking you. Okay, guys, everyone okay with these two models? We move on then. Another aspect which talk about management of receivables. Now, of course, we will not be completing this part, but I just want to give a push start and the remaining aspects we will be covering on the last lecture of this management of working capital, that's on Tuesday. So what is receivable management, guys? I talked about earlier that receivables management, where we talk about in terms of accelerating my collections, that was one piece. But the problem is that when we were discussing that about the liquidity and profitability as an example, there could be an option of selecting a problem of selecting wrong customers who do not have a good credit background. And that is why receivables management is very important, that entails planning and controlling the debt owed to the firm. Of course, you need to understand that yes, if you're talking about large receivables, the lenient credit policy could have a risk of bad debts, cost of collection, opportunity cost. Who knows better than you? Everyone so diligently studied the opportunity cost or the cash cost in terms of the working capital calculations, right? Now, if you're talking about low receivables, of course, that is something. If you want to keep low receivables, you probably can achieve it by having the strict credit policy, but that would definitely mean your sales volume may go down. So it's again the trade-off between the profitability and liquidity. Okay. Hitesh says plan to acquire or recover funds from debtor in an efficient manner is receivable management. Absolutely, Hitesh. The only thing is it entails a lot of points, one of which is a credit policy, another is a due diligence, and then you're talking about control. Control means you keep the monitoring, aging analysis, following up them for the collection piece. So what's the credit policy here? So trade-off between, as I've been saying, it's a trade-off between profits and liquidity, right? So trade-offs between profits on additional sales that arise due to credit being extended on one hand, and cost of carrying those debtors and actually not getting anything out of them as a bad debt is on the other hand. So it's like a trade-off. Should we have a credit policy of 90 days or should we have a credit policy of 30 days? If I have a credit policy of 90 days, people like, everyone will come to me, right? Wow, 90 days. Who will not like? But then I will be having my funds blocked for 90 days. That's a problem. Some of them may deteriorate in the market. Some of, they may not pay me. So then that's a risk of bad debts. But what if I want to keep a credit policy of 15 days? Wow, I want a quick collection. But let's say my competitor is providing a 30 or 40 days, then they will run to the competitors. Now, a good example here is of a sample of credit terms. If you can see on my screen, Smita has a question. Lenient credit policy means. Lenient means a longer term period. Like instead of 30 days, you want to go for a. So Smita, if you're talking about going from a 30-day period to having let's say 60 or a 90-day, this is lenient. But let's say if you're having 60-day period, but you're going to a 30 or a 15-day period, that's a strict. So this is strict, this is lenient. Okay. So guys, a good example of how the different customers, vendors have something called credit terms. Credit terms in their contracts called as 2x10 N30. Now, what does this mean is this particular example means that credit period for this customer is 30 days. But if they are going to pay you within 10 days, in that case, they will be offered 2% credit, the cash discount, 2% cash discount. Guys, can you analyze this term now? 2x10 N30. 30 days is a credit period, but if you get the payment in 10 days, you'll get the cash discount. Now, the problem is that okay, it's up to the customers who have to evaluate, right? You have to evaluate whether you have to give 30 days, 45 days, 60 days. That's your call. Customer will evaluate whether they want to give you within the discount period or not. Because see, they can get 2% discount for 10 days, paying 10 days, but they have to arrange the funds 20 days earlier. So it's up to them how they want to analyze, how they want to evaluate. What are the, Smita says credit policy explanation. Smita, what happened to the credit policy? Smita, if you have a lenient high or a longer credit period, you will have more sales. I explained that, I guess. If you have a longer credit period, you will have more sales. But you may end up having a bad debts. If you have a shorter credit period, you may lose some sales. You may have faster collection, but you may lose some sales. Make sense? This is the same thing we discussed in the last lecture when we were talking about profitability and liquidity slide. The trade-off. Guys, everyone clear on this credit policy or the credit term example? 2 by 10 net 30? Can you please confirm? 2 by 10 net 30 and 30. It is generally also known as 2 by 10 and 30. So what are the factors that could affect my credit policy? Should I go for 30 days or 90 days? What's the conclusion then? Of course, we have to consider the effect on the sales profitability. But the most importantly, I would be concentrating on customers' reputation as well. I would be seeing, okay, what is the cash discount I'm offering versus what is the interest in market. So these are the factors. Of course, your own policy will be very important. Factors, every company have to decide what credit policy they can keep. Now, we're talking about a credit analysis or due diligence. This is another aspect of receivable management. This is your checking the customer background. Risk analysis, right? You can check in the industry. Then we are talking about control of receivables. Now, this is more of an internal stuff. How you want to manage or follow with the debtors, monitor them, do the aging analysis. Aging means if you have some debtors, right? Let's say you have a debtors of 2 lakhs. So I would do an aging analysis, 0 to 30 days, 30 to 60 days, more than 60 days. Let's say 1 lakh 60,000 is here, 30,000 is here, and 10,000 is here. So my total debtors of 2 lakhs are kind of covered under this aging. Now, when it comes to the aging analysis, the objective is that we have to understand the possibility of the bad debts. Here it is, the possibility is very high. Here it can be moderate, but in the current phase, it may not be there. It may not be any possibility of bad debt because these are your current transactions. Guys, everyone okay with the aging analysis? Everyone okay with the aging analysis? Can you please confirm? Hitesh says aging can also be report. That's fine. You want to call that as an aging schedule, aging report, that's fine. Guys, all okay till now? So control of receivables, how you monitor, how do your aging analysis, and how do you monitor your credit policy? Achha, one more thing is, we talk about monitoring of credit policy. What if you gave the, what if there is a new customer, guys? I'm talking about very practical stuff here. What if there is a new customer? If there is a new customer, initially, you may be hesitating to give them a longer credit period, yes or no? So let's say there is a new customer, you are giving them only 15 days. But when the relationship starts, when you become familiar, you get comfortable, probably you want to extend from 15 to 30 or 45 days. Right? So what we will be doing, guys, not today. I don't have the time right now. But we will be continuing our discussion on Tuesday to approaches to credit policy evaluation. We'll be starting from this slide. There we'll be discussing what is my present scenario of the credit or the credit period given. What is my current policy? What are the proposed policies? Let's say, as an example, we are talking about a present policy of 30 days, proposed policy of 45, 60, and 90. In each of the scenario, we'll talk about what will be the sales, any other costs associated with that, variable cost, fixed cost, more importantly, bad debts, because longer the credit policy, bad debts may increase, but the sales may also increase, cash discount expected. So the idea is that what we'll be discussing here is from the present policy, how much profit will be increasing. Not only that, we will be comparing that with any opportunity cost of investments. See, if you are relaxing your credit terms, do you agree that your debtors will increase? And if your debtors will increase, remember my discussion from working capital. My discussion from working capital, what happened was, if our debtors are increasing, that there is some cash cost which is blocked. And if that cost is blocked additionally, you will have some opportunity cost attached to that. That means you could have invested that money somewhere else. So we will be discussing, we will be starting our concept on this one, majorly on Tuesday. That is your approaches to your credit policy. And we will be also continuing to some important aspects. So one is this. We'll be talking about the credit policy evaluation. We will be talking about the different terms. And in terms of the changes in the credit sales, changes in the cost. I hope everyone can correlate that. Not only this, one important aspect that we'll be covering after understanding this will be your financing of receivables. So there are few things which are still left, which we will be continuing on Tuesday, guys. So I want everyone to please buck up. And I'm sure that you guys come prepared and we'll have a lot of fun then. Right? So we will try to cover up the remaining aspects. And if the time permits, we will be doing at least one question of practice again from our working capital discussions. And you will have a couple of questions as an assignment as well. So thanks, everyone. I think it was, again, a good, fun-loving session. A lot of knowledge exchange, a lot of queries from you guys. You guys have been always a good, bunch of students who have been clarifying your doubts at every stage. And that keeps on the momentum, that keeps on the two-way traffic going on. So we'll meet on the, on Tuesday, that is on 20th, guys, on 20th of September, and we'll wrap the working capital stuff. Till then, please carry on. Good work. Keep on studying. Make sure that you keep your targets fixed. Your examinations are coming nearer, and I'm sure you will do great, guys. Best of luck and have a good evening to all of you. Cheers.